Hi, good afternoon, ladies and gentlemen, and welcome to our second Investor Day presentation. Thanks for joining us today to what I hope will be a very interesting set of discussions in terms of presentations by two of our business units in the packaged foods and food staples and packaged foods reporting segment. So today we're going to talk through grains as well as packaged foods business. And both these businesses are relatively new in the Olam fold. Both have started in the last 5 to 6 years with a fairly rapid expansion in both investments as well as scale over the last 2 to 3 years. And it'll be interesting to note that these are two businesses in which we have rapidly built up a regional niche and expect these two businesses to be businesses that will be a large part of Olam's portfolio going forward. So without, sorry, it's my pleasure to firstly introduce the head of the grains business, Suresh. Casey, just to clarify, has no relationship to the Casey Group, but is a long-time Olamite, actually a born-again Olamite in his case. He joined us in late '94 in East Africa. Setting up the initial business there in Tanzania. Stayed on there for quite a while to set up the whole region and was the regional head there. Moved to Singapore, was running the cashew business for us, and then left Olam to pursue further studies, worked outside Olam, and then rejoined us about five and a half years ago when we decided to set up the grains business. And in the last 3-4 years, or the last 5 years, has assembled a really crack team, which he will be introducing shortly, and built a new business for us, which is one part of our invest and grow portfolio in the next 3 to 5 years of our strategic plan. We're going to start with the grains presentation, a presentation which should hopefully last about 45 minutes, after which we'll like to leave at least 30 odd minutes for question answers. We'll take a short break of 10 to 15 minutes and then come back again for the packaged food, and I'll probably see you again to introduce the packaged foods team. Just a clarification in terms of, and based on this particular investor presentation has been basically designed to provide greater insight and input into the businesses which comprise our reporting financial segments. So we have completed one for the nuts and spices businesses, and based on the feedback out of that, we have tried to populate as much of that feedback into these presentations. The presentations are really intended to provide a deep dive into what is the coherent strategy which is driving each part of this business. From the outside, our strategy seems very complex because it's a series of moving parts with a biscuit manufacturing unit in Nigeria and a dairy manufacturing unit in Russia. But the way we run and operate our businesses is by building a bottom-up strategy in each of our product platforms. And we'd like to provide you the coherence in that strategy, how we have scaled up those platforms. And these two platforms will give you a good idea of how we have done that in two recent initiatives that we have launched just about 5 years ago. So without further ado, let me invite Casey to talk you through our grains business.
Good afternoon, ladies and gentlemen. So grains is the first session for today, and I'm going to walk you through the grains platform in Olam. So this is the global grains team. I'm going to introduce all the speakers who are going to be talking today about the grains business, and I request them to just stand up and say hello to you. So I'm joined here by Saurabh Mehra, who's the head of our milling business, and looks after all the African milling business. Saurabh is a Olam veteran, has been with us since he joined us a long time ago, has worked in various businesses and products and geographies. Joined the grain business about 4.5 years ago when we started the platform, and has been with us running the Crown Flour Mills Nigerian operation for the last 4 years. since the acquisition, and he just recently moved to Singapore to oversee all our milling businesses in Africa henceforth. I would also like to introduce to you next Richard Hedges. Richard has also been a pillar of the business for the last 4.5 years since we started the business. He's a milling expert and a technical expert for us. He's based in Ghana, was involved in the very first acquisition in doing all the technical due diligence, and has been involved in building and expanding capacity in all the geographies where we have built up mills. Richard comes with many years of milling experience, built up largely in working for ADM in the UK. The next speaker is going to be Alexander Basara. Alex has been with us again for nearly 4.5 years, joined us in 2009 when we made our first small baby steps in Russia, has built a formidable position for us in Russia as the second largest grain exporter that we are today. Alex also comes with many years of working experience, having built up his experience in large global trade houses. And finally, I'd like to introduce to you the newest member of the grains team, David Johnson. David's been with us now for less than a year. He runs our Australian grains operation. Again, tremendous reputation and credibility in the industry that David brings along with him, and has been in the grains industry for many years. So with this, I'm going to start off the presentation, and the agenda is roughly as follows. First, I'm going to take you through the grains global footprint. Where are we today, where our offices are, and what do we do where we are. Then I'll take a step back and walk you through the strategy. How did we go about devising the strategy that we have today? And then you're going to hear from our operating managers, 2 from the milling side and 2 from the grain origination and trading side, where they'll talk you through how we have executed on this strategy in the last 4 years. And finally, I'll come back and wrap up, and if there are still some questions unanswered, then we'll take up the Q&A. We believe we've built a significant and successful business over the last 4 years. We started off in 2008, and we started with what we know best. And what we know best is the Olam core of origination and trading. And we started with a trading office in Singapore, Melbourne, and Russia. Our next stop was the acquisition that we did of Crown Flour Mills in Nigeria. We then started to build a new mill in Ghana. A few months after we completed the Nigerian acquisition. That was a greenfield mill. And by around that time, we realized that we needed to get some skills in understanding wheat and the various wheat qualities and the relative value of wheat, and also in getting some capabilities in bulk freight. A majority of the Olam businesses were moved by containers and not in bulk freight, and grains was one of the first businesses where we would have to transport and do the logistics in bulk freight. So we acquired a small trading team in South Africa, Durban, who were experts in the African continent. They were selling a lot of grain into the African markets, so they understood the requirements of those markets and also had ocean freight capabilities. The next year was our year of expansion. By that time, we had kind of figured out how to make money in this business, what works and what doesn't work, and we expanded quite rapidly in that year. We expanded by putting up 2 more greenfield projects, one in Senegal and Cameroon on the milling side. And on the trading side, we started the Ukrainian trading operation akin to our Russian operation. We also entered the United States with a small trading office to understand what goes on in the US wheat values. It's an important driver of world wheat markets, and being present in that market on a day-to-day basis allows us terrific visibility to how to act on the other origins where we play. We also acquired ocean freight capability in Melbourne, because the Durban team was focused on the Atlantic market, and we had to get some expertise on the Pacific ocean freight markets. And we also made an investment that year in a port-based asset in Newcastle, which is the silo that we own in Australia as a part owner. Finally, we entered Dubai with a marketing office. Initial 3-4 years where we were mainly selling FOB, didn't go to destinations. And now that we had ocean freight capabilities and we had sufficient volume we wanted to go to destination markets and build deep customer relationships, and we started the marketing office in Dubai to address the Middle East and Mediterranean markets. And then the last year, in 2012, we did two things. We entered the Canadian market with a joint venture with Lansing, which is a large domestic U.S. Grain trading company. That's a 50-50 JV. And we did it once the Canadian Wheat Board was dismantled and the market was liberalized. And we also completed the acquisition of an asset in Azov Seaport in Russia. That's a logistics asset. It's a port terminal that allows us a stronger foothold in the Russian origination and trading business. Today we can say that we are the third largest wheat miller in Nigeria and Ghana, and we are the second largest exporter out of Russia. So why do we have this portfolio of businesses? Why are we present in all these different geographies? So I'm going to take a step back and walk you through the way we thought about entering this business and what our strategy is. First, some mega trends that we saw and that we continue to see. The first 3 points relate to the supply side, and the last 2 points relate to the demand side. So on the supply side, we started to see increasing supply come from two new origins. One is Black Sea countries, which is Russia, Ukraine, and Kazakh, and also in South America from Brazil. These countries were relatively marginal countries, but in the last 4 or 5 years have become significant origins and have contributed to a large portion of world trade flows. We also saw dismantling of traditional monopolies. The Australian Wheat Board was dismantled sometime around 2008, and then the Canadians followed it about a year ago. The dismantling of the monopoly wheat boards opens up the market for international players and new companies to go in and make a market for themselves, make a space for themselves. On the demand side, on the wheat flour, there are only two markets where wheat consumption is growing and continues to grow. One is the sub-Saharan African market, and the other is the Southeast Asian markets. Most of the developed countries are kind of saturated in their consumption of carbohydrates, and wheat per capita consumption is not growing, neither is the population growing much. So, in fact, we see in many of the developed countries a small decline or saturation of demand. And finally, the story of ethanol. One of the things that has gripped the grain industry in the last 4 years is a new source of demand. The new source of demand is ethanol. Usually in commodities there's a joke that goes on that says that if demand is growing by 4%, it's not bullish, it's bearish. It's bearish because the prices are so low, that's why the demand is growing. Commodities is really characterized by supply side stories most of the time. But that changed 4 years ago with ethanol coming in, a totally new source of demand for fuel. And then we see now some kind of saturation in growth of ethanol demand. The blend wall is a reality, and it is going to stay. And the world, however, has responded to that story with a lot of supply in corn, especially coming from Brazil and Ukraine. And therefore, we think that we are going to have fairly burdensome corn balance sheets. That's going to take feed demand out of wheat away, so no wheat is going to get fed, and therefore that loosens up the overall grains complex. And that augurs very well for demand growth, especially in wheat, in those markets where we think there is going to be continued growth. So, looking at the industry itself, this is world trade in the main grain commodities, wheat, corn, barley, and oilseeds. We all know that it's a very consolidated industry. The players in this industry are very big companies, very well capitalized, have been in existence for, 200 years, and have very strong market positions. We were a relatively late entrant starting this business 4 years ago, and we had to find a differentiated strategy. We had to find a way to compete in this marketplace that will allow us to win. So the key questions were, which products, which geographies, and which value chain? So if you look at product fit, one of the ways we looked at it is on the left side you see the supply countries, on the right side you see demand countries, the three main products, wheat, corn, and soybeans. And we try to ask ourselves, which of these products fits very well with our geographical strengths? So one of the underpinning theme here is our strength is in sub-Saharan Africa. That's where we have grown a lot of our businesses, and that's what has allowed us to get market leadership. And between these three products, the one product that fits very well into sub-Saharan Africa is wheat. It's a significant market. It's about 10-11% of global trade, which is not small, and it's also a growing market. Even on the supply side, we found that there were greater synergies with wheat with our existing geographical footprint. Russia and Ukraine were relatively not fully consolidated supply markets. We had an opportunity to get in there and consolidate our presence. And with the acquisition of Queensland Cotton in Australia, we had developed strong grower relationships on the cotton side, and that could be leveraged also on the wheat side, because at least in New South Wales and Queensland, the growers for cotton and wheat are common. So from that, we derived that wheat is the best fit for us, and our entry strategy into the grain space was based on wheat. If wheat was the chosen product, then the next question is which value chain? So this is the wheat value chain. So we've got farming, and then after farming, you have to have storage and logistics assets to store the grain and to move it to port, and then again logistics assets at port to elevate the grain to ships. Then you have to originate, procure, and trade and manage your risk around that supply chain, and finally you can mill it. The farming business is not very profitable, especially if you take market values of land. However, in certain geographies like Russia, if you can access land at fairly low market values and you can unleash the agricultural potential of the land, then farming can be profitable as well and give you good returns on equity. However, it is fraught with management challenges and it requires a lot of execution and management in order to make it work. The elevation and origination and trading, usually participants operate in both of this together. There are rare instances of people doing only one of the two. Each of them is complementary to each other, and this is the market space that is quite consolidated. Again, it depends from origin to origin. A lot of the old origins like US or Europe are fully contested, and some of the newer origins in South America and Black Sea, the market is still not fully consolidated, and there's an opportunity there. And when you look at milling, milling is an interesting industry. We look at milling as two different markets. One is domestic milling, which is when you mill in a country that grows wheat. And the other is imported milling, or when you mill in countries that cannot grow wheat. Now, wheat is a winter crop. It's really grown in temperate countries, so it's like US, Europe, Canada, Australia. You need a strong winter. And in all the countries around the equator, whether it's Southeast Asia or the Middle East or the Mediterranean or even South America, Brazil, you really can't grow a lot of wheat if you have really a tropical climate all through the year. So these countries have to import, and when they import, the industry ends up being quite oligopolistic. There are not lots and lots of millers in any of the imported country milling, usually 3, 4, 5, and it renders itself to minimum efficient scale. Minimum efficient scale comes mainly through ocean transportation, because the cost of freight dramatically reduces as you increase the size of the ship, and that reduces the cost of the wheat into these countries. Second, access to port land. Access to port land is limited, and those who initially get access to it establish for themselves a strong market position and they build capacity around that. And finally, there is a minimum efficient scale also in the amount of capital that you need to deploy to put up even a small mill. And then the amount of working capital required to run that mill is even more than the fixed capital that you put into it, because of the long supply chain lead times that are involved, especially in the import of wheat. So that ends up being oligopolistic. And then when we look at specific markets in it, like Sub-Saharan Africa, we thought that's perfect for us, because not only is the industry structure good, we also have a strong ability to compete and win in that marketplace. So based on that, this is our strategy page, a one-page strategy slide that talks of what our strategy is, and I think it follows naturally from what I have discussed so far. We said that we want to be a 10% market share in Sub-Saharan Africa in wheat milling. That is the first part of it. And the second part of it is identify specific origins where you can procure and export and trade wheat and still win the game. And those are really the Black Sea countries and to some extent Australia. So we want to invest in logistics assets in these countries in a smart, intelligent way, in those assets that create value in order to make for ourselves a decent competitive position in export and trading of wheat. So in order to do that, we have done acquisitions, we have put up greenfield mills, we have acquired logistics assets, we have built trading teams, and we've been executing on that strategy pretty much to our satisfaction so far. I am going to now invite my colleagues to talk you through how we have actually executed on this strategy. So first I'd like to invite Saurabh, who runs our milling part of the business. Welcome, Saurabh.
Thank you, Casey. Good afternoon, ladies and gentlemen. So we just saw that one of the key planks of our strategy is to mill in sub-Saharan Africa. And I would like to just take you through some of the examples of how we've gone about executing them. But before we get into details, just a quick one on what is the size of the pie we're talking about. Sub-Saharan Africa really imports close to about 15 million tons of wheat. It accounts for almost 10 to 12% of annual wheat trade. It's a large market. It's a growing market. It's a market which is characterized by a tropical climate and hence will largely remain a destination market for wheat for the foreseeable future. But what is sub-Saharan Africa? I mean, it's a big term. We're talking about geography which is almost includes more than 40 countries. So one of the first questions that we had to answer to ourselves was, which countries do we choose? Where do we enter? What should be the first country, second, and so on? What should be our phase one? To answer that question, we put together a set of matrices that you see on the slide here. And then we went about ranking various countries on those matrices. And based on the relative rank, we devised the countries and devised our entry strategy. So let me just take you through some of them in a little bit more detail. So we looked at various things. We looked at things like what is the market attractiveness? That means how attractive is the market? What is the structure of the market? What is the population? What is the demographic? What is the level of development, level of urbanization? Bread, noodles, biscuits, pasta, all of these which need wheat flour are essentially consumed in the urban side. So we looked at these sectors to tell us what is the pie today and what is it that we can aspire for in these markets. We look at the government policies. It's important to have a government policy which is conducive to for agri-processing and specifically the development of the food sector. In any country, if you look at and where you see a very robust downstream business, you will find that at the core of it, at the heart of it, is really a very viable wheat milling business, because that really forms the nucleus. It's from here that you can go downstream into the added products of biscuits or noodles and pasta, where of course our PFB division will take over. Then we also looked at Olam's history in the country, and I think that probably is one of the most important part to focus on, because in a country where Olam presence was there, we could really bring to bear our strengths. We could look at sharing costs, for example, country costs, admin costs, legal costs, to achieve cost efficiencies in the country. We could bring in country capabilities and project management skills that we have developed over a period of time. We have large Pan-African networks of customer sharing and of channel sharing that other products of Olam have built, for example, rice, sugar, dairy. And all of these we could leverage together and really bring to bear the strengths of that Olam has built in sub-Saharan Africa and help us execute our strategies better. We also looked at what are the import tariff structures. The tariff structures themselves are not important. We don't need to have import tariff for protection for a viable industry. Industry is viable. Of course, our import tariffs do help in having a better margin structure. But if you just look at the countries, there are two essential factors to focus on. Most of the wheat exporting countries do not tax wheat exports. Secondly, the logistics of movement is overwhelmingly in favor of moving bulk wheat against bagged flour. So these two together ensure that the destination milling always remains viable. So the import tariffs are good. They are good for the margin and hence for the business, but they're not critical. So based on these various parameters, we came up with 4 countries that we wanted to enter in a phase 1. First, we are looking at Nigeria and Ghana, where today we already have a wheat milling business, a very successful business in both the countries. And we have Senegal and Cameroon, where we have ongoing greenfield projects. These are likely to get commissioned in June and December next year. Getting into the details in Nigeria, Nigeria really was the first port of call for us. I mean, it is the largest market in sub-Saharan Africa. It is one of the larger markets, in fact, in the world. It's a growing market. We are talking of 160 million people, 50% of whom are actually urban dwellers. It has a very young population, a median age of just about 17.8 years, which means that, again, the demand for the downstream products is extremely high, all pointing to a good cause and a vibrant market for us. When we looked at the Nigerian market, we went and evaluated various companies to focus on, and we finally selected Crown Flour Mill. Let me just tell you a little bit about Crown Flour Mill. So CFM was the second wheat milling company that was established in Nigeria. It is an old brand. And just prior to the acquisition, I remember traveling through the length and breadth of the country, and we spoke to a lot of dealers and bakers and industry participants, really understand what is it that we are really looking at. And what we found out was that here was a brand. Their brand was called Supreme, which was extremely well known, very well respected, but over the years had fallen to the wayside. Just lack of investment, lack of focus from the previous management. And that really told us, okay, this is exactly what we are buying. We know that we are buying a brand which can be revived, which is well known and respected in the industry, which is exactly what we did. We went about recalibrating the brand. We invested in quality, invested in delivery systems. We moved away from low-margin industrial segments to high-margin retail segments. We went about segmenting the country, and we produced brands and products tailored to different parts of the geography. Some of it you will probably bring to bear as we hear our later presentations in our PFB division also. And you see that a country even as vibrant as Nigeria has extremely different and ethnic variations across the areas. So there is not just one wheat flour that you're producing. You're producing different products for different areas. And we understood that and we created that. In fact, at the end of the first year, buoyed by our growth, we went and undertook the expansion project. And we expanded the wheat mill, which completed in July of 2013. So today, as we stand, we are the third largest wheat mill in the country. In a short span of 3 years, we have grown our volumes in excess of 250%. Our capacity utilizations have gone from low 30s to well above in high 60s and 70s, including the expanded capacities. So we have a very strong and a robust business in place in Nigeria. The next port of call was Ghana. Ghana is again a growing country, a politically very stable country. It has very good governance processes in place. And we looked at the market. We looked at, again, various acquisition targets there. Unfortunately, we found that the valuation expectation of the current assets there and our own expectation weren't in sync. But then we had a very rich history in Ghana. We had been in the country for 20 years. We believed we could take on a greenfield project, the first for grains business, and we just did that. We went ahead and put up a plant in a record time, which is now, as a result, in just about under 2 years of operation, we are the third largest miller in the country, and again, growing on quality and volume terms. I think what I really want to be the key takeaway is that, ladies and gentlemen, we identified the strategy of wheat milling in sub-Saharan Africa. And for us, there were two pathways. It was acquisition and greenfield. And I think through these two projects and these two examples, what we did to demonstrate to ourselves and to the larger world was that we could choose either of the paths and execute it successfully and have a business that we can be proud of and lay down the foundation of a very strong and growing businesses. Going forward, we have currently 2 new greenfield projects running in Senegal and Cameroon. And I would like to invite Richard Hedges here to take us through these projects. And Richard will also take us through what are the technical skills and excellence that we are embedding into our wheat milling business to ensure a robust business going forward. Richard?
Good afternoon, ladies and gentlemen. Currently, we're running 2 projects. We have a 500 ton a day flour mill in Senegal, and we also have a 500 ton a day flour mill in Cameroon. Now, looking at the pictures on the top left-hand corner, I think you'll see that the design or the mills, whilst they're different colors, they are exactly the same mill. So, from a technical perspective, what does the technical team bring? First of all, the technical team obviously clearly understands milling, and one of our key areas is firstly project management, and secondly project learning, and taking our project learnings from the Ghana projects, from the CFM projects, developing our processes, developing our systems, and allowing us to move forward. In the Cameroon and Senegal examples, what we've done is we've built exactly the same mill, or are building exactly the same mill, right down to the office block, the number of offices, the milling process itself. There is absolutely no difference between the two processes except for the number and the storage available to us. 20,000 metric tons of wheat in Cameroon and 25 in Senegal. This has allowed us, first of all, to save significant amounts of money, reducing our investment. But also it allows us to put up a mill now in record time. If you speak to most milling engineers, they will say it takes about 24 years from signing a contract to bringing a mill into full production. We have cut that down to less than 20 months, so it's a significant saving on time. Saurabh talked about differentiation of products and expanding our market in Ghana. Both in Ghana and in Nigeria. What we have done in Nigeria is we have deliberately created a central research and development facility. And what that allows us to do is to select wheats from different origins. And there's two important parts, or three important parts to milling. First of all is the raw material, wheat. The second one is improver. And the third one is actually how we mill the product. By understanding and using a strong technical sales force and understanding our market, we have been able to segment it, as Saurabh has said, and actually using different wheats and in different improver types, create commercially very viable and suitable products to a huge range of customers. In Ghana, we had started with one product. We now have 7 or 8 products, each going into specifically different types of market, whether it's for pasta manufacture, bread manufacture, biscuit manufacture. All of these require different flour types. One other interesting thing that we've done in Ghana is we've developed what we call bakery technical services. And bakery technical services is about trying to break into the market as quickly as we can. We've linked up with a renowned bakery equipment manufacturer in Africa, and we and they have almost what I could call a joint venture. We supply the on-the-ground technical support, they supply the equipment. So we identify various customers, they bring the equipment from the supplier, we install it, we train the bakers, and we then allow them, or they then take our flour. Some of the benefits to the baker are that they are able to increase yields, which is particularly important to them, improve the quality of their product. And there was one significant statistic I learned the other day. There was one baker came back and he said that he had saved 50% on his gas consumption, which to him was a lot of money, but of course to us as an international company is reducing our carbon footprint. Finally, we must be doing something right to have gone, for example, in 2011 in Ghana with no flour sales to nearly 80% capacity utilization today. Okay? With our strong technical sales force, I've talked about the diversity of products that we are providing for the marketplace. The other thing that's very important is consistency of product. And we are using new technology, online measuring systems, technology to increase shelf life. Shelf life can be a real problem in Africa because of the high temperatures. We're ensuring that we've got extremely robust food safety processes, investing in metal detectors, magnets, and all of the equipment that one would expect from a world-class manufacturing facility. Finally, if I may, I would like to hand to Alex, who will take us through the Russian operation. Thank you.
Thanks, Richard. Together with my colleague David, we'll take you through Olam's origination strategy in Russia and Australia. First of all, I would like to explain why Russia was chosen by Olam as a point of entry in origination. What was the rationale behind it? And there are some reasons for that. First of all, Russia is the largest country in the world, and it has tremendous reserves of arable land. A significant part of those are black soil lands that are optimal for grains production. Not all of this land is being in use. More than 20 million hectares have been abandoned since the dismantling of the communist state and can be brought back into production with adequate efforts. Secondly, complementing the arable land, there are huge reserves of fresh water, which is becoming an issue worldwide. And thirdly, the current status of agricultural techniques and technologies in Russia is quite inferior, and this means low yields. To give you an example, the yields of wheat in Russia on average vary between 2 and 2.5 tons per hectare, whereas in the neighboring EU it is minimum 5 tons. So there is a huge potential of increasing grains production through implementation of modern machinery, better varieties of seeds, adequate plant protection systems, and overall techniques and management. In combination, these three factors determine that Russia has a tremendous potential to increase grain production. And this means that the exportable surplus can go up dramatically. So virtually Russia is in a position to double its exportable surplus in the foreseeable future. This represents a unique opportunity that was noted by Olam, and Olam acted upon it. Some part of this growth potential is being realized now. Since the turn of the century, Russia has become a steady net exporter of grains, and is now firmly placed within the world's top 5 exporting countries. The average amounts of exports are in the range between 18 and 25 million tons per year. Of course, exports are a function of domestic S&D, and we see there was a drop in exports in the season of 2010-11 when Russia got hit by the worst drought in the 200-year history, when 1/3 of the crop was written off. The other significant element for origination is logistics. Logistics are vital for any supply chain, and grains market is no exception to that. So the exports from Russia they are split in 2 almost equal flows. The biggest part, about 55% of Russian exports, are channeled through deep water ports on the coast of Black Sea, through a number of port terminals that are available to the industry. And this fact, contrary to examples of other countries in the world, represents a level, competitive market environment for all the trade. The second part, about 45% of exports are flowing through the coastal ports that are capable of loading 3,000 to 5,000 tons on coastal-sized vessels. And this part of the export flow serves the closer market destinations in the Mediterranean basin. Here in this segment, most of the port facilities are owned by principals in trade, and the availability of such assets is very limited to third parties. Olam has got both. We are a sizable shipper in all independent deepwater facilities, being the second largest exporter out of Russia. And we are a sizable and notable participant in the coastal market, being an owner of a port terminal in Azov. Olam's history in Russia is short but quite notable. We have started in 2009 with a small team of just 3 people and have grown consistently to become where we are now. Our growth was organic, slow. For a long period of time, we actually were keeping a very, very low profile in the Russian export market. But this was done for a reason. We set us the task of building a very strong foundation for our business, which entails a very robust procurement base, which is Olam's forte in most of origins and products worldwide. Building a good structure, internal structure, setting the processes right, getting the risk management systems in place, developing a profound understanding of supply and demand, local and global, and ensuring an adequate marketing reach. We have set a network of procurement offices in most of the production areas of Russia. We have manned the team with the best resource we could attract in the market. And upon executing on this part of our development strategy, we felt that we were in a position for a step forward that would take us to the next level. This was when we understood that we could go for an investment. This investment came through in 2012, upon termination of which we became an owner of a port silo in Azov on the estuary of the Don River. This asset has the storage capacity of 48,000 tons. It can load a coaster a day, and its annual throughput capacity is around 800,000 tons. We saw a task and challenge in actually extracting the real efficiency out of the asset and proving the true value of it. And this was never done by previous owners. This task entailed very complex integration of the asset and its operations within our overall training operations, and ensuring coordination between logistics, procurement, production operations in the silo itself, freight logistics, sales, and all other little aspects of every part of this complex business. This worked fine, and to our satisfaction, we have demonstrated within a year from taking over the asset, we achieved a historically high rate of performance of the silo, which is now turning around 100,000 tons per month, which was never achieved before. Acquiring the silo actually helped us strengthen our position in the Russian market and entrenched our business deeply in the export-oriented provinces of Russian South. Now I would like to pass over to David.
Thanks, Alex, and good afternoon, everyone. Well, why Australia? Why does Olam want to be in Australia? Well, firstly, there's nowhere else you'd rather be, is there, than sitting in Australia and operating. But more importantly, Australia is annually the second or third biggest wheat exporter in the world and the first or second biggest barley exporter in the world. So under normal crop circumstances, we're exporting between 20 and 30 million tonnes globally, and that makes Australia a very important part of establishing global prices for grains. So even if you're a flour miller on West Coast Africa consuming US hard red winter wheat or Russian wheat, you want to know what's happening in the Australian crop because our crop influences US and global wheat prices. Importantly also, Australia exports from 18 ports, very widely dispersed geographically across the country, and we've got a very significant domestic market of about 10 million tonnes that needs to be serviced as well. As Casey said, since 2008, when the old Australian Wheat Board, the export monopoly, was deregulated, the industry has been changing extremely rapidly. Although it would be considered a mature industry, since that time we've seen very, very significant investments by three of the global big grain companies in Glencore, Cargill and now ADM, trying to buy and get control of significant parts of the supply chain. That has led to other investments, and we currently have 3 new export berths or terminals being under construction or complete in the last few years. And we see an ongoing process of investment in the supply chain in Australia that's going to be going for, I think, at least another 10 to 15 years post that deregulation period, as companies try and differentiate their supply chain and create a footing that's more competitive and provide better servicing back to Australian growers. Other major changes in the Australian market in the past few years is the ongoing growth of on-farm storage from growers as they change their marketing timing and programs. A very different market now compared to the regulated market in 2008. And the other most significant change is the increasing in export grain going out in containers. Now we're seeing roughly 3 million tonnes of wheat going out in containers into Southeast Asia annually. Olam commenced its grain business in 2009 in Australia and has had very steady growth through that period. Just stepping back for a second into the supply chain, it's important to understand post-deregulation that the Australian government created what they call an open access regime. So everyone in the industry has access to storage and port facilities owned by other operators. Open access is very different from operational control. So even though anyone can go and buy grain at a site and move it to port and put it on a boat, you are beholden to the providers or owners of that asset to provide those services. So having access is one thing. Successfully executing bulk shipments is an enormous challenge, especially when the providers of those services are also your competitor in the marketplace. And now you've got Glencores and Cargills and ADM currently, who are highly competitive in the export marketplace, providing those services from basically regional monopoly supply chain providers. So our model in Australia at the moment is very much one of a pure trading model, taking advantage of internal trading opportunities in the country, whether that be flat price or basis, servicing, importantly trying to service domestic consumption, and participating in that container market, which we see continuing to expand into Southeast Asia. But obviously leveraging off the framework on the information within Olam's global grain business, it's a global industry, and it's very important to understand what's happening in Russia or the US or Europe and all of the other major supply and demand points around the world. The model we have in Australia now is going to be very efficient in working capital because we're not obliged to hold and carry grain. It means we can continue to leverage the relationships we have with very significant growers, as Casey mentioned, who supply the Queensland cotton business in New South Wales and Queensland. And that's going to be very important when I get to my next slide as far as our investment in the port facility. But at the moment we are trying to reduce our exploitation or manage the amount of risk we take within the supply chain in Australia, but at the same time continue to leverage relationships with growers and build that container and domestic market opportunities. The first step for Olam in infrastructure in Australia is an co-investment in a new export terminal that's currently being built in Newcastle. You can see there, brand new, nice shiny silos, 60,000 tonnes of storage capacity is now complete. This terminal is going to be commissioned in December this year, so it's very exciting. And we're aiming for the first vessels come January, February next year. The ship loading facility, which you can see on the bottom right there, is actually, interestingly, has been fully commissioned already in China and is currently sailing from China to Australia. It arrives in 2 weeks' time, so it'll be something to see a 300-tonne ship loader being plonked off a ship onto the berth and ready to go. So that's going to be, as I say, the first step in Olam gaining some control over the bulk supply chain. And as I mentioned earlier, we think there are going to be ongoing opportunities in Australia as that supply chain continues to evolve, and I'm sure there'll be more terminals built and there'll be more competition, which will create a very different environment to operate in over the next 5 to 10 years, and that's going to be an exciting place to be. And we think as part of Olam's global footprint, Australia is going to be a place where we'll be able to provide a reliable source of grain and along with the information that's important for the rest of the business as well. I'll now hand back to KC to pull it all together.
Okay, so I'm not going to take long now. I'm sure you guys are dying to ask us some interesting questions. But just to kind of wrap up, you've seen what our global footprint is. You've heard what our chosen strategy is and why it is what it is. You've also heard from all our operating managers how we have so far executed on that strategy. I just want to dwell some time on what's our competitive position. What's our competitive advantage? We have two sources of competitive advantage. The first source of advantage is quite an obvious one. It's called the Africa advantage. It's essentially our ability to operate in that geography better than most of our global competition majors. But also, with respect to the local competition, we get added benefits because of our presence in multiple products. So because we are distributing not just wheat flour, but also sugar and rice and dairy and to some extent even packaged foods, we get opportunities to share customers, costs, channels and capabilities, and we get organizational synergy benefits. The second source of advantage is a little harder to understand, but is a significant source of advantage for us, which is really we are probably the only miller who is as integrated in the value chain in terms of origination, bulk freight and trading compared to any of our miller competition. And our presence on the wheat, especially on the wheat global trade flows, is fairly significant. We are there in almost every wheat origin. We exist in US, although with a small trading presence, in Canada through the JV, in Australia and Black Sea, you've heard already from David and Alex. And also being present in the bulk ocean part of the value chain, both with our Melbourne as well as our Durban office operating in Pacific and Atlantic. We really understand world wheat trade flows. We spend a lot of time understanding S&Ds and balance sheets, understanding relative value of different wheats at every point in time, and therefore we get visibility to arbitrage opportunities and ability to procure the best wheat at any point in time in order to give us the lowest cost grist. And we execute on it using the benefits that we have of a crack milling team who is able to use any, or not any, but within a limit, a wide varieties of wheat with improvers to deliver a consistent standard flour product, which compared to our competition, we are well ahead on that aspect. So these are the two main sources of advantage that we get in our chosen strategy. And so what's the way forward? So we were selected as an invest and grow platform in the recent strategy refresh exercise that we did at a corporate level, and that's good news. And obviously that is a testament to the fact that we have executed on a differentiated strategy quite well. And we think there are opportunities to grow in the following 4 ways. First of all, where we have already put up capacities we will soon and every year see opportunity to increase capacity as we start utilizing greater and greater portions of our existing capacity. We already saw that in corn flour mills. We got into CFM in 2010 and we completed the expansion of capacity just 2 months ago, and we are seeing some very encouraging results in terms of capacity utilization already just 2 months into it. Similarly with Ghana. So even in Senegal, Cameroon, and also the existing markets, we will see opportunities to increase capacity in existing markets. The second, we have a short list of various other sub-Saharan African markets that we have not yet entered, that we can enter, both in West, Central, as well as in East Africa. Then we will also continue to make very prudent, value-accreting investments in logistics assets in those countries where we are already present, which is Russia, Ukraine, Australia, to enhance and consolidate our positions. We're not going to make, I don't think we have the appetite to make a multi-billion-dollar acquisitions, but we believe that we can create extra value at a certain scale and at a meaningful level by consolidating our presence in the origination and trading parts of the business in these geographies. And finally, we will also look at entering some new high-growth milling markets, as a fourth plank of growth. So with that, I thank you, ladies and gentlemen, for your patience and for listening to our presentations. And I open up for questions. And I request my team to come and take the stage. And we are here to take your questions. Thank you.
Questions. Housekeeping rules, as Shekhar mentioned, we will not be sharing any financial information at a product level. We only disclose financials at a segment level. But anything on strategy, anything else that you choose to know, the whole team is available and at your service. So, go ahead.
Hi, Trania from CLSA. Just I'll start the ball rolling. Russia is a very interesting place to do grain, given their weather volatility has seen one of the craziest crop peaks and troughs in that market. We've seen Noble suffering the same fate when they couldn't get their soybeans out from the Argentinian market. Going forward, if we see the Russian export market suffering another impact, how is that going to affect Olam? What's the strategy around it?
Of course, Russian exports are subject to fluctuations in weather, and that affect the crop. But we believe that, and we see it from the statistics, that the production of grains in Russia has a tendency to grow. And as we touched before, there is a huge potential to increase of this production in line with the growing world demand. So we believe that despite the drops in exports that will happen, naturally they will happen, the overall trend of growth for Russian exports is going to be realized.
Just if I might add to that. In 2010, we were there when the ban happened. Would we still traded a sizable volume servicing domestic customers? So one way to overcome this is to continue to get some volumes through by servicing domestic customers, which is part of our strategy. And the second is Russia is part of the WTO. And so their ability now to unilaterally ban exports is going to be limited as they have become members of WTO. They have not 13, 14, but 12, 13 was also quite a short crop. There was a lot of rumor that Russia might ban exports again, but they never did it. Actually, they kept assuring the whole trade that we won't do it. The trade didn't believe it. and eventually exported most of the exportable surplus out in 4 months, and then everybody was just sitting there doing nothing for the rest of the 8 months. But slowly, I think the fact that they didn't do it will build credibility for the government going forward, and people are going to believe that that's not going to be the option that they can use just by banning exports. They can intervene in markets and use various other methods that are available in order to ensure domestic prices.
Thilan from HSBC. 2 questions from me. You mentioned a lot about your ocean freight capabilities in Durban and Australia. Could you just expand a little bit on what the strategy there is? Would you be looking at owning ships at any point? I'll get to my second question after that.
No, we won't own ships, but we will, of course, have vessels on long-term time charters. So we are not looking at owning ships, but we'll own the days by virtue of owning long-term vessel time charters, which is a perfect hedge to the fact that we have to move almost 1 million tons of wheat into our milling markets, which gives us a short freight exposure. And similarly, on the origination front, if you have origination, you have assets, you have to move the grain into destinations, which also gives you short freight exposure. So, yeah, so not own ships, but to operate ships and to own long-term period charters.
It's probably worth adding, KC, that those chartering businesses are also providing services to other Olam businesses. So they're doing bulk rice, sugar, and palm oil as well. It's not just grain. So they're providing potentially fertiliser. So there's a broad servicing of other Olam businesses as well from that chartering business.
Yeah.
Thank you. The second question is, you said that you've got some of the best capabilities to blend different types of wheat, deliver consistent flour quality and things like that. Why can't ADM do that?
No, ADM does it in the markets where they mill. They mill in the US, of course they do it. I think they mill in Europe, they do it. But they are not present in the markets where we are milling, which is Sub-Saharan Africa.
Right. Thank you.
Yeah, thanks. It's Chuck Spencer from Morgan Stanley. Thank you all very much for coming and making today's presentation. Just in trying to connect what you're saying today and what's presented to us in your quarterly results, there was a big volume jump last year in the grains business, or at least in the segment that this business rolls up into. It was identified that nearly 4 to 5 million ton increase in volumes in this segment coming through primarily from grains. Can you give us some insights into how that's showing up? Because Crown Flour Mills was acquired in 2010, and I guess the Ghana plant, which started up, is only 150,000 tons.
Yeah, that really, the volume growth comes from the origination and trading part of our business, which is really, the Russia, Australia, Ukraine, Canada, US, and Singapore parts of the business. And also from the mills, but you've identified how much the mills do.
Okay, so it's coming from the origination side and the trading of that, as opposed to the sale through to Sub-Saharan Africa. Is that what you're saying?
Sales into Sub-Saharan African markets, other than the mills, of course, it comes from that as well. We have customers that we service in the Middle East, in the Mediterranean, in Sub-Saharan Africa, and in Southeast Asia as well, for what we export out of Australia. The mill volume is there, what is there, and will continue to grow as we increase utilization and put up new projects. But a lot of the growth that we had in the last 2-3 years was also underpinned by the growth in the second part of our strategy, which is the origination and trading part of the strategy.
Okay, got it. And is there anything you can share with us on the profitability split between the origination and trading side and the milling side. I would have thought that more of the earnings might come from, or more of the contribution margin might have come in from the downstream and the value-added parts of your product differentiation, but maybe you can give us some help.
I will not be able to get into the specifics, but both, as I highlighted in the industry structure and the profitability of the industry, there is money to be made in both origination and trading part of the business, as well as in the milling part of the business. The trading is obviously less fixed capital intensive. It's more working and risk capital intensive, but gives you a good return on equity as long as you bring your core capabilities to bear. The ownership of logistics assets enhances the value by giving us a little more risk-free fee-based income profile to that business. And the milling business, of course, is significantly more fixed and working capital intensive.
Thank you. I have a question on, maybe directed to the gentleman from Australia. Just trying to understand the comment about the growth in exports via containers. Maybe can you elaborate why that's the case? And if I recall, I think Olam had a venture with a Canadian company, I think maybe 1 or 2 years back, that dealt with the export of wheat via containers. So what is the whole strategy around trying to export what is actually a bulk commodity in containers?
It's probably a few different parts of that. Firstly, probably a reflection that AWB, the old wheat marketer, focused more on bulk. They did export wheat in containers. It was in about I think it was about 2004 or 5 when the bulk freight market went through the roof, so to speak, for the first time, and more than doubled from its historical values. At that point in time, containers became cheaper to execute into Asia than bulk. So ironically, it was better off for consumers to buy in containers than buy a Panamax vessel. And since deregulation, there's probably a broader market of customers that have opened up who are utilising Australian wheat of various qualities. And that flow of exports has continued to expand. It's really constrained by the amount of empty food-grade export boxes you get. So it's constrained by the amount of imports Australia makes, predominantly into Sydney and Melbourne. That's where the greatest export of grains going out the door. So it's a combination of, at times, the freight rates that the shipping lines offer into Asia, sometimes extremely cheap and aggressive, because otherwise you're taking empty boxes back to bring imports back in, and a broader range of customers who obviously have to utilise less capital to buy smaller volumes of grain. So I hope that.
Hello there. Adrian Folger from Standard Chartered. I've got 2 questions. There's quite a few instances you sort of refer to yourself as being number 2 or number 3. I'm intrigued, who are number 1 or number 2 in those instances? Particularly, are there any listed companies we can look at for comparative purposes? So that's my first question. Who are the number 1s and number 2s when you talk of yourself as being 2s and 3s?
In Nigeria, the number 1 is listed in the Nigerian market. It's a flour miller, but I don't know if I think it's listed as across the segments that they participate in.
Yes, right. It's not only as a flour milling. It's a conglomerate, so it's not just a flour milling business. It's food sector as a whole. They list as an entity.
It's called.
It's called Flour Mills of Nigeria Group PLC. So you can. Yeah.
Ghana, it's a privately owned company. In Russia, the rank that we refer to our last full marketing year export rank. The largest was one of the global majors. Yeah.
Well, my second question is just sort of, the investment in logistics is a very big theme in agriculture. So you made that comment right at the end of your presentation. Logistics is somewhere you want to spend money. Can you give us an idea of what quantum we're talking about and where? What's the priority line for Olam?
Yeah. We have already, for example, the two cases that we highlighted, the investment in the AZT, which is a port-based elevator in Russia, as an investment we've already made, and then the Newcastle Agri Terminal in Australia and the Port of Newcastle, that's also an investment we've already made. And in these geographies where we have chosen to participate in the origination and trading part of the business, which is basically Black Sea, Russia, Ukraine, and Australia, they would be the priority countries for us to make those logistics, additional logistics investments. Only in the existing. We are not looking at US or Europe. Canada, the JV is looking at some opportunities. It's a 50-50 JV with a very well respected and large domestic US trading company that has already made lots of investments in the US in logistics. So if the JV comes up with the right opportunity, we will look at it.
Hi, this is Nikhil from Goldman Sachs. Now, just a follow-up question on the volume growth that we have seen for this division over FY13. Given for the milling capacity of milling volume growth will be driven by the capacity addition, can you comment on how should we think about the volume growth in the origination and the trading division going forward, for example, in FY14 and beyond, especially looking at the huge volume growth over the last year? Thank you.
Yeah, we started off from a very low base, so you saw a lot of growth. So it would be, of course, very hard to sustain that kind of pace of growth on the origination and trading part. The milling part of the business will continue to grow as we bring more capacity on stream and increase utilization in existing capacity.
Thanks. So would it be fair to say like a 10 to 20% volume growth on the origination from the high levels of 70 to 80% growth from the lower base that we have seen in the last part?
Nice try.
Okay, thanks.
Hi, this is Phil from Morgan Stanley. Few questions on the Crown Flour Mill. When you acquired Crown Flour Mill in 2010, you set up certain targets in terms of volume, earnings, profit, and returns. And you also mentioned that you expect to achieve steady state about in 2012-13. Can you share with us to what extent has those targets been achieved today or in the last financial year?
We are very satisfied with, more than satisfied, I would say, with the results, both on all fronts, as far as that asset, that investment is concerned. So I don't think I'll be able to exactly tell you how we performed with respect to what we said that asset would give us at the time of acquisition in terms of the specific numbers, but we are very happy. We wouldn't have invested in capacity increase. And please note that all the capacity increase has come with no increase in footprint. It's exactly in the same location that the existing mills were, both in Tin Can and Wari, that we were able to increase capacity. So really no addition of people at all. And you get all that extra productive capacity to bear. So it's obviously all of that is in a business that has such high operating costs, like any milling business, because of the fixed cost of the nature, it gives you tremendous operating leverage.
Maybe just on volumes alone, I think you were looking for about roughly 400,000 tons at the point of acquisition. Are you close to that number?
We've actually exceeded the number. So if you see the slide that we presented, post-capacity expansion, the new capacity will be 714,000 tons a year. So the original investment thesis for Crown Flour Mill's acquisition is more than exceeded.
Okay, thank you.
This is a question about the Russian operations. We started operations in 2009, and very quickly we've become the second largest exporter out of Russia. I'm just curious to know, is that, what have you done differently that has allowed you to take that type of market share? Is it just the market has been growing very rapidly, and you've also taken market share, or have other competitors exited the market? What have you been doing differently that has allowed you to do this in Russia?
Well, I'll just give a brief answer and maybe Alex can expand on it. The thing about Russia is that it's a level playing field. The ownership of the biggest constraint for any new entrant to increase volumes and share in an origination market is the ownership of especially the port assets, port-based elevator assets. And if you look at any country like US or Europe, there are not many companies that own. For example, I'll give you an example. US exports hard-hit winter of Texas Gulf. And there are only 3 companies that have ownership of elevation assets out of the Texas Gulf. So if you want to buy hard-hit winter wheat, you'll go to one of these 3 companies. So that's the nature of this industry. Whereas in Russia, most of the good, advantaged, low-cost, deepwater port assets are owned by people who are not principals in the trade. So they give open and free access to everyone, and we don't suffer any disadvantage there. And on the shallow water ports, we now own an asset. So that gives us actually an advantage over those who don't own an asset. So that is one aspect of Russia that allows us to grow share compared to the others. The second is, once that is sort of leveled, then you bring to bear other capabilities. And the other capabilities that we bring to bear in that business is not very dissimilar to what we have brought to bear as an organization in a lot of other products like coffee or cotton or cocoa, which is essentially your procurement. How well can you buy? How do you manage the supply chain risk, which is the inventory risk, and how well you manage the trading risk and understand the derivative markets to hedge and manage your trading risk. So grains, the difference between other products and grains is the massive amount of fixed capital investment that you need in most origins, whereas in Russia, today it is like this, as I have explained. Australia is also, Australian Competition Commission allows open access. So those are the reasons why we choose to go to those origins.
Thank you.
Yeah.
Hi, it's Conrad from Macquarie. If I look at the 4 sub-Saharan African markets where you have a physical presence, is there a risk of overcapacity in any of them? Are there any other greenfield projects that are currently being worked on due to complete this year, next year, whenever that you can see? Because if you just look at the capacity of what you've got there versus the market size, it's already quite substantial. We know that there's at least 3 players in all these markets based on your rankings. So where is the risk of overcapacity greatest? Thanks.
If you look at these 4 markets, to the best of my knowledge, there is new greenfield projects that are happening in Senegal. There is none that I'm aware of as of today in the other countries. In Nigeria, it's a more developed market in terms of milling. It has a rich history of milling. It's in excess of almost 50 years. So there are always new projects that are coming up, but that's more a replacement of capacity. That's not necessarily new capacity coming online. So yes, there is. If you go to Nigeria today, you will find a lot of new mills coming up, but that's just a question of new modern mills coming, more energy efficient mills coming in. So that's just to. So that's not really adding to existing capacity. Mostly, what the mills that are coming up in these areas that we see are addressing the current market as well as market growth. So given the lead time in putting up a mill, which is almost like Richard mentioned, 24 months. So you're really putting a view on what the market is likely to be and putting up capacity there. So right now, we believe in these markets. Now we are well placed to utilize the capacity that we are putting up.
Alongside the stuff that you're doing in all of those markets.
No, like I mentioned, there's only in one.
Senegal.
Senegal, there's a new mill coming up. No new projects that I'm aware of in Ghana or Cameroon.
Okay. Cool. Thanks.
Hi, this is Anubhav from UBS. Was just wondering in terms of the infrastructure bottlenecks. I mean, in all these markets, obviously you're developing quite a lot of infrastructure, but in getting the grain from your facility to the port or whatever, I mean, do you think one of these markets or maybe all of them, what are the kind of sort of infrastructure bottlenecks that you might be facing or you're facing right now?
Is your question with reference to where we originate from or with the destination milling part of the business?
No, just in general. I mean, where I'm coming from is there some sort of bottlenecks with respect to sort of lack of infrastructure that you're facing right now in any of these businesses or one of these countries which is more susceptible in this regard?
Can I comment about Newcastle? So one of the complementary opportunities behind the new Newcastle terminal in Australia is a more efficient rail system. Currently in Australia, export rail trains are 2,200 tonnes, which versus the US system where you get 10,000 tonne trains appears horribly inefficient and is. That is due to the lack of investment in under-rail resources in Australia over many, many years. Behind Newcastle is an opportunity, thanks to the coal industry, I might say, that up to Narrabri there's a heavier gauge rail line where there's a potential to put in a bigger train and ultimately a 4,000 or 6,000 tonne grain train. That would dramatically impact rail freight rates and give you an extremely advantageous position in the marketplace. Those sort of opportunities we're certainly looking at and seeing that they are the types of investments that would change the supply chain in that port zone totally as far as upcountry grain storage and the movement of grain to port. And that's the potential that we would look at as an adjacency behind that Newcastle mill to give you a very, very strong position. So yes, and I think there are going to be more of those opportunities in Australia where you've got a relatively old storage system, as I say, underinvestment in rail resources. The investments that change the nature of the supply chain are the ones that are going to give people competitive advantage, make it attractive to growers, and give you a strong footprint.
All right, if there are no further questions, we'll have a 15-minute break and then we'll get back with packaged foods. Thank you.
Thank you.
Thank you.